ये तुम्हारा है? मुझे लगा मेरा लिखा। हाँ। Good afternoon, everyone. We are now starting with our next session, the second technical session, which is on evaluating global financial architecture and regulatory practices, progress, and way forward. This session will be chaired by Y.V. Reddy, who is the former Governor, Reserve Bank of India. And among the panelists, we have Jaimini Bhagwati, who is the RBI Chair Professor ICRIER, Ashima Goyal, who is a professor at IGIDR, Rakesh Mohan, who is a senior fellow at Jackson Institute of Global Affairs, Yale University, and a distinguished fellow at Brookings, India. Chetan Subramanian, a professor at Indian Institute of Management, Bangalore. Over to you, Professor Reddy.
Thank you very much. Friends, at the outset, I'd like to express my gratitude to ICRIER, to Professor Ahluwalia, and to Mr. Katuria. I didn't intend to be here, but by accident I'm here, and I'm very happy to be here. I've met so many old friends. I'm really delighted. I'm grateful to you. I think we'd agreed that there won't be any introductions. We'll try to attempt towards an end for a conclusion. Shall we start? I will request Professor Ashima Goyal to make the presentation.
Thank you, Dr. Reddy. I'd like to thank ICRIER for the invitation and congratulate them on putting together such an excellent sessions at such short notice. So, presentation. We are asked to evaluate the international financial architecture and regulatory practices. So there have been many achievements, but there are also threats. And I think one of the major achievements has really been the recognition of the necessity of regulatory reform and systemic reform. The various problems, the threats which I would like to highlight are large debt, leverage, continuing leverage in the system, then arbitrage, because a lot of the reform was focused on banks, so shadow banking has become a big problem. Then there have been surges of capital flows related to QE and general global risk on, risk off, and emerging markets have borne an excessive share of the costs. And I will argue that this follows from weaknesses in the reform, which has been too bank-focused. And there are possible, simple, sort of universal measures that would have reduced tax-based or price-based, that would have reduced leverage and systemic risk, which were underutilized. The FSB itself, in its recent annual report, has flagged 3 areas for ongoing attention, to continue and to improve the reform of the global financial architecture. And the first that they focus on is market liquidity. And here, market liquidity risk, and here I would say that the risks are probably overestimated, partly because of the success of reform. That although there is less depth in certain markets, banks are not doing market making, but the quality of assets is better. And the building up of more liquidity buffers means that systemic effects would be reduced. Some institutions are more robust. And although we've seen withdrawal of QE that was expected to frighten markets, but the communication and gradual sort of normalization markets seem to have, apart from the initial taper off sort of tantrums in 2013, markets seem to be functioning well. So all this you could put under the benefits of ongoing GFA reform. But there are sort of questions there that if banks do less market making, can there be problems in the future? Can markets freeze up? There's more electronic trade, so does that maintain liquidity or can it lead to herd behavior and sort of freezing? So we have to see going ahead. But on the whole, so far, things seem to have worked better. The second issue the FSP highlights is the effect on emerging and developing economies. The third is worries about maintaining an open and integrated financial system. Here the Trump effect comes in. It's difficult to maintain an open anything these days. There are worries about it. But I think highlighting these issues and other aspects suggests that there is possibly some openness to a rethink about financial regulations. And so this issue of corporate debt and leverage, we hear a lot about, and especially for emerging markets as a threat to the global financial system. We hear a lot about this in India. And recently, there was the BIS numbers that come out, 2017. So I just looked at the comparison across different kinds of economies. The total, what they call core debt, which is nominal debt, as a ratio to GDP for India compared to all economies, advanced economies, emerging markets. And there's some very interesting sort of stylized facts you see here, which are very unexpected given the Indian debate. The first is that the total credit to the non-financial sector in India is very, very low, the credit GDP ratio. 128 compared to 190 for emerging markets, almost 300 for advanced economies. But our credit to government is much higher than for any other kind of economy. Emerging markets, it's 47, we are at 68. But still, all economies and advanced economies have much more government GDP ratio. Then the total credit to the financial sector is, the private financial sector is absurdly low in India, just 60 compared to 142 for emerging markets. So that seems that we are just not able to provide credit to our firms. You talk about a credit boom in the last session, but here we seem to have credit scarcity. Households have a pathetic amount of credit, just 10 ratio to GDP, compared to almost 40 in emerging markets. Total credit to corporations is again much lower than, we talk about an emerging market sort of loan problem, but our companies are borrowing less than 50% of GDP, while emerging market average is more than 100. And it's similar in other economies. Then bank credit remains very, very important, because one of the features over this post-crisis period has been that markets have grown at a rate of about 40% in emerging markets, but as providing credit. But still, if you compare the total credit, the third column, and you see this total credit, and you see the bank, you see that only about 4% is going from markets. So there's very little growth of markets in providing credit in India. So it would suggest that we can't afford to neglect any source of credit. We talk about shutting down banks, but first markets have to work, and otherwise we just don't. I'm on this ECB committee, and we're seeing that there's a net outflow. Firms are repaying; they're not borrowing even internationally. What is permitted? But for the globe as a whole, what we need to note is that global rise in credit is as much as in the pre-global financial period, but real growth has been much lower. So credit is not delivering growth either in this period. And for emerging markets, the cost of this bank-focused Basel III, the core focus on banks in financial reform, has a tremendous cost for emerging markets that depend on banks for their credit. And we see that India remains largely dependent on banks, including firms, including government. Our alternative modes of delivering credit have not really developed. So some key macro-prudential tenets are that if the stock of credit rises, then this indicates a buildup of risks. But we're seeing the stock of credit is very low in India. If the rate of growth of credit rises, that's better at capturing turning points and at predicting systemic risk. But what the textbooks, what research tells us is that gradual relaxation of some macroprudential constraints should take place when systemic risks recede with time. Now in India, we have no systemic risks, but strong macroprudential constraints. And then they may also be relaxed when risks materialize, which are periods of financial stress, prompt relaxation of macroprudential, especially when provision of credit to the economy is binding. Now look at this graph, which tells us non-food, growth of non-food credit to India. You see that it's falling very, very steeply ever since 2011. So credit has been shrinking, but we're talking about capital adequacy and macroprudential tightening in this period. And this is non-food credit to industry. It's actually been negative in the recent period. Growth rates have been negative. So there seems to be some kind of pro-cyclical contraction in India. Overall, we've seen a huge rise in emerging market corporate debt to more than 4 trillion after the post-crisis period. In India, it's just rose to about 100 billion, but our NPAs have risen to about 200 billion in this period, domestic, not external debt. And this is a period when an asset quality review, this period when asset quality review was imposed when domestic interest rates were high. The NPAs have doubled from 2013 to 2016. And you see that even if you say market borrowing, corporate borrowings from market is much lower than it was in 2011. So corporates are not borrowing. It's not only the banks, bank credit, which is a problem. It's a demand for credit. They're not borrowing from the markets also. And private banks are focused on retail credit, and public sector banks are also shifting to this. So there's nobody who's really willing to lend to firms now. Then the other sort of threat in the global system is the rise of shadow banking. This is the arbitrage issue, the leakage issue. If your regulations are focused on banks, then hedge funds developed. In mutual funds, the global assets under management rose enormously, doubled in this period, and they now account for 40% of global financial assets. And in general, shadow banking, China, but in China, it's still less than it is in the US. So shadow banking is a huge problem. And the reaction of the FSB to this is really to focus on better data and information to regulators, to data harmonization, legal object identifier, but all this will take some time. There are legal issues, so it's all at an early stage with some progress expected by 2018. And moreover, focusing on information means that you depend upon regulatory reaction, which tends to be delayed and ex post. So what would work better is ex ante incentives, and there's been some openness now to this and a change in reforms towards things like haircuts on all, because the thing with this kind of retaining securitization, skin in the game, those kind of reforms that reduce the incentive for taking risk. But again, this is very tentative and is going slowly and will sort of really kick in by 2018. So again, all this is at an early stage. But the thing with those kind of reforms are that they change your incentives and they can be universal. It's not just restricted to banks. It can go to non-bank financial institutions also. So some of these measures are part of macroprudential tools which are designed for systemic risk and apply outside the banking system also. Among these tools, there are lender-based and borrower-based, such as caps on debt to service, loan to value, while lender-based would be caps on loan to deposit. So while some of these are buffer stock or liquidity-based, but others can be price-based tax or just simple leverage caps, which are very simple to design. So these are simple tools. The FSB and the IMF focus on the role of buffers, on reducing leverage, on reduced stress tests, interlinkage among the financial sector, but again, I'm just collating from a lot of IMF research and other research, academic research, and we see that the way financial regulations have gone, there's really a gap between research and what has been implemented, research and reality. For example, research focuses on the issue of leakages or arbitrage and shows that this is much more for capital buffers, but the focus, Basel reform, is on capital adequacy, capital buffers. And moreover, hedge funds are different from banks. They are agents, not intermediaries. So capital adequacy won't do for them. But, and then simple leverage caps are easier to apply universally. They can also apply to shadow banks. Yet there's more emphasis on buffers. Prudential measures are more effective in reducing leverage compared to buffers, even for banks, where the emphasis has been on buffers. But buffers are used more. Research shows that to reduce distortions and efficiency costs, you need to first introduce tools that affect lender behavior, such as reduce a bank's incentive to lend, for example, before introducing quantitative constraints on borrowers. But more borrower-based tools tend to be applied. So there seems to be a big gap between what theory and academics tells us we should do and what we are actually doing. Then emerging markets as a whole use much more macroprudential tools, 4 times more intensively before the global financial crisis. We have people here who were pioneers, and India was a pioneer in applying some of these kind of tools even before the global financial crisis. And as advanced economies begin to use these, then it's fallen to 3.3 after the GFC. But still, emerging markets are using much more of these kinds of tools. And then capital flow management, since they are at the receiving end for volatile capital flows, then capital flow management tools that decrease systemic risk are counted as macroprudential. And examples could be tax on non-core foreign exchange liabilities, caps on foreign exchange derivatives. And the current global advice is that you can use these, but with many restrictions. First, explore all possible macro policy responses, such as reducing government spending and so on, and then microprudential. Then you need to show why intervention is necessary. Do not discriminate on residency. Make sure that you meet market-making obligations, etc. And in general, the action has to be taken by borrowers, not lenders, while research suggests that it's better if lenders are targeted first. Lenders first, these tools apply more on lenders. So again, costs are borne by emerging markets, very often when the sources are external, not due to their own policies. So what FSB, when they say that they are looking at the impact on emerging markets, is really to say that global banks have reduced their presence with the emphasis on more capital adequacy. But this bank-focused reform has really imposed costs on emerging markets also, because they tend to be more dependent on bank lending. And the point is that since emerging market size has now grown, if costs are imposed on emerging markets, then that reduces global growth and creates spillovers for others. So I'll just end with a few remarks on I feel that the international regime is more open to sort of addressing these weaknesses in reforms. And again, Trump could perhaps be, because earlier on there was a decision that financial taxes limits, each country should take a decision. There was no agreement on universal tax. I think the IMF was trying to push this. But today there's a realization that these simple kind of tax-based reforms can be more easily applied universally. In the US, there's a realization that Dodd-Frank imposes enormous legal costs. It sort of runs into 10 volumes, and you need an army of lawyers and so on. And today, the Trump administration is attacking this. There's a recent senator who suggested a trade-off, a choice to banks, that you can hold more capital or you can take more risk. If you hold more capital, you can take more risk. So the idea is, and Mervyn King similarly had, so these sort of suggestions would allow these, allow you to choose a sort of reform kind of regulation that suits you better. Emerging markets, which tend to use more microprudential, could hold less capital buffers. Some of the stress on our banks is because you're asked to meet all sorts of capital adequacy requirements as well as a stringent macroprudential regime. Regulation would be simplified. There's a tendency to just impose more regulation. UK has this rule that you knock out 2 to add 1. And so the choice between capital adequacy and equivalent macroprudential measures could actually allow more standardization and increase global coordination, policy coordination in this area, where if one nation alone imposes a tax on a stricter micro, then capital goes elsewhere. So this is an area where coordination really pays. If there's some move towards, I think the G20 IMF needs to work out these sort of packages. What are quantify the sort of trade-offs that are possible here? And there are some hopeful new developments, regulatory innovations. Regulators are also looking at business plans. Japan's financial service agencies bringing in forward-looking sort of incentives rather than just checklists, seeing how banks can help businesses. India also, we've closed our development financial institutions too quickly, but there's an idea that you need to provide risk capital for firms. So can you have special sort of discounted credit facilities combined with markets and market developments that could be more robust? So, and then regional alternatives such as bilateral swaps, Chiang Mai Initiative, AIIB, which will provide competition to the current global architecture and perhaps move it in better directions. Thank you.
Thank you to ICRIER for inviting me for this conference. I'm afraid I wasn't able to show up this morning when I was listed for the first session also. My apologies for that, but it was just sort of unavoidable. I'm afraid I'm going to talk, Ashima has done an amazing job of summarizing what's been happening over the last 7-8 years. I'm going to take a much broader, like 200-year perspective on international global financial governance. And in some sense, the question sort of arises, why is this discussion of interest today? And it has indeed increased in terms of intense discussion in the recent years. Part of my thinking on this started while I was at the IMF on the board, and the IMF has a quota reform every 5 years, and something that was agreed in 2010 was then not finally approved till 2015. There was a lot of foot dragging. In fact, there was the longest delay that took place in agreement on a reform which was actually agreed in or implementation of IMF reform in terms of the governance of IMF. It took 5 years to implement it after it had been agreed, and that was the longest delay in its history. So to some extent, I thought much more about it, and there's evident reluctance. What it sort of demonstrates in a way is the evident reluctance of advanced economies to countenance change of economic power to emerging and developing countries. Now, of course, there's even further questions that have been put forward now in terms of what's going to happen to global economic governance, in some sense which has been relatively stable since the Second World War for just about 70 years. And with Mr. Trump withdrawing from the Paris Climate Change Accord, what is noticeable in some sense in his remarks was he spoke much more about India and China, which again is symbolic of this not willing to accept the change in global economic power that is taking place. He's also in the business of disengaging from trade accords. We don't yet know whether he might even start disengaging from the WTO agreements. That has not been said yet, but he might. Again, We've had a trade regime in the world since the Second World War, which has been stable, and there's been continuous progress in one direction on more open trade with general consensus on the issue. Again, he further signaled on his intention on this issue when he refused to agree to the G20 communique in the last meeting, a communique that has had the same language since November 2008. Again, signaling that the US was withdrawing in some sense with a general agreement on more open trade. So there's an unraveling going on on the post-World War II consensus on global economic governance. So if you think more broadly on this, what in some sense find is that we're really on the,